Can you avoid overleveraging in farm market peaks? Have you ever wondered if it is possible to avoid overleveraging during farm market peaks? Let's break this down and see how you can manage your investments wisely. Overleveraging happens when a farm takes on too much debt compared to its assets or income. This can be risky, especially when market conditions change. During market peaks, farmland values and farm incomes often rise. This can tempt producers to borrow more money to expand or buy additional land. However, if prices drop or interest rates rise, this can lead to financial trouble. To avoid overleveraging, it is essential to understand market cycles. Farm markets are not static. They go through cycles of highs and lows. Recognizing that high prices can be followed by downturns is vital. If you borrow heavily during these peaks without considering potential declines, you may face financial stress later. Another key factor is maintaining a strong equity cushion. Farms with higher equity per acre tend to be more resilient. By avoiding excessive debt, you can build a stronger equity base. This acts as a buffer during downturns and reduces the risk of insolvency. Monitoring your debt-to-asset ratio is also important. Keeping this ratio below 40% can help balance growth opportunities with manageable financial risk. Higher ratios can lead to losses and liquidity problems if market conditions worsen. Assessing your exposure to interest rates is crucial too. Rising interest rates can increase your debt servicing costs. If you are highly leveraged, you may find it harder to manage these increased expenses, which can reduce profitability. Evaluating your repayment capacity is another step to consider. Look at your income projections, operator experience, and risk tolerance before increasing debt. It is important to have enough cash flow to cover debt payments, even during tough times. Using conservative financial planning can help you avoid relying solely on rising land values or short-term income gains to justify borrowing. Always plan for scenarios where prices might fall or costs might rise. Diversifying your income sources can also improve financial stability. Reducing reliance on a single commodity or revenue stream can lessen the pressure to borrow excessively during market peaks. In practice, farms that manage their leverage wisely during market highs are better positioned to withstand downturns. Historical trends show that firm busts often follow cycles of rising leverage combined with falling profits and rising interest rates. By learning from these patterns, farms can prioritize sustainable debt levels that align with long-term financial health. For those involved in farmland investment strategies and agricultural real estate trends, avoiding overleveraging during market peaks is essential for long-term success. Focus on risk management tools, maintain strong equity positions, and carefully evaluate borrowing decisions within the context of market cycles. This approach will help protect your operations and investments.